This week's theme on the Retirement Quick Tips podcast is the 2024 mid-year economic and market update. I can't believe it. We are halfway through 2024 already. And today I'm recapping what's happened in the first half of 2024. This is actually really hard to do. I'm not going to sit here and complain, but it's tricky because how do you sum up and try to make sense of all the different things that are happening in the world, especially even when you narrow it down to, okay, what's driving the economy, what's driving the stock and the bond markets? It's a lot of different moving parts, and each area has a different bit of influence on another. And so it is really tricky to try to summarize and kind of hypothesize about what's been driving the economy, the market so far this year. But I would say to sum up, it's just a lot of mixed signals in the economy at the moment. But because the two biggest drivers of the economy, which is spending both from the consumer and government, and also businesses as well, businesses not quite as much, but definitely consumer spending has been relatively stable. Government spending continues to balloon. And the cracks aren't yet appearing in something like a higher unemployment rate. So at least for now, it appears that the economy, even though it's not growing all that much, it's not like we're in some robust growth environment. It's not bad either, at least as far as the economic growth. Now, you might talk to people, depending on their situation, how much they've been affected by inflation or higher interest rates, that are really pessimistic. And you might talk to other people, like a lot of you listening to the podcast. I would put myself in this. I'm locked in at a barely over 3% mortgage. I'm not trying to buy a house right now. I'm not suffering with higher rents. I do see that my grocery bill is a lot higher. I see that my insurance is going up. So I see other areas that are eating into the bottom line in my pocketbook and my bank account. But there is definitely this split. This is not just in individuals. So I think more than anything else, that's sort of the defining feature of the current economic and market climate that we find ourselves in. And the real story with the economy for most of you listening, it is all about interest rates and inflation. And there was this hope that the Fed would start lowering interest rates this year, but that hasn't really happened yet. The economy is actually probably too strong. The cracks aren't deep enough yet, and inflation is too sticky. So it seems unlikely at this point that the Fed is going to lower interest rates. And if they do, you might get a little bit, but not a meaningful amount. And then you have inflation that really hasn't budged in a year. It's still much higher than the Fed's 2% target. So it's unlikely, I think, the Fed will lower rates meaningfully until some more progress is made on the inflation side of things. Now, if you get a little bit granular, you look at something like manufacturing. Okay, the entire manufacturing component of the economy has been in a state of contraction or decline for over a year, since late 2022. So we're talking a year and a half now. But then you have the services side of the economy that's been growing. So, they kind of been balancing each other out in that the services side of the economy has kept things in a state of growth, even with manufacturing in a period of contraction. With that, you have an unemployment rate that is pretty stable. It's pretty low by historical norms. But then again, you look under the hood there and you see that there's a decline in full-time jobs. There's less hiring in the private sector. Most of the new jobs right now, especially in certain areas like Oregon where I live, they're in government, healthcare, and education. The lack of robust hiring in the private sector is a problem, and a big one at that, but it's not likely to send us into a recession in the short term. And then you have the consumer. You and me, we make up the majority of the GDP or the economy. And unfortunately, there are some signs of stress there too. But again, it is very much split. So you have housing affordability. It's the worst it's ever been, at least by a lot of the measures that I've seen. Groceries, other essentials, they're a lot more expensive today because of inflation. Many Americans are struggling with higher interest rate. They have credit card debt, they have car loans, rents are up, mortgage rates are up if you're trying to buy a house right now. And as of last fall, the 40 plus million borrowers with student loan debts have started to repay those loans as well. Then on the other side of it, you have wealthier households, especially those with mortgages locked in at 3%. Their stock portfolio is higher in the last year and a half. Their savings are actually earning interest again. You can get 5% on a high yield money market account right now. And there's not these big, broad layoffs, and you don't have this uptick in unemployment that would cause a lot more stress financially for Americans. So you have an entire group of Americans where they're not feeling the pain at all. And that's actually a pretty large group. It's a lot of baby boomers, a lot of people who are further along in their career, more established, have a bit higher net worth, some savings in the bank account. And then you have millions of Americans who are pretty much left behind over the last several years. We've now find ourselves in a situation where for a lot of middle income earners, lower income earners, large percentages of the overall American population, they have less household wealth, they have less discretionary spending, they have less job security, especially in areas like manufacturing. They have higher interest rates, they have sticky inflation. These are all big problems. We need a healthy and growing middle class. Income inequality, I remember listening to someone talk about that back in like 2009, 2010, and how bad it was at that time. And it's only split even more. Again, you need a broad, healthy middle class in order for the economy and the economic growth to be sustainable. The bottom line is that this is a very strange economy. It is growing for sure this year, but not by that much. And many are getting left behind. At the same time, the cracks are not deep enough yet to really push us into any sort of imminent recession. Where we're at, again, it's very strange, but it's positive, both in the market growth, bond returns are finally meaningful again, and you have an economy that, at least for a lot of pockets of it, not all, is in a state of growth right now. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.